enabling the digital economy.
Great. Thank you very much for everybody that's joined us today. I have a very illustrious panel here to discuss something that I'm personally very interested in, infrastructure around crypto assets. Hopefully it's something that those of you who've joined us or those of you who will be watching this later also find interesting. We've kind of come a long way with crypto assets. If we kind of look at a very narrow measure with cryptocurrencies and related things, we've gone just under a decade now from zero up to now more than 200 billion US dollars. That's probably only a small representation of what's happening outside of that space and what are being delivered by the gentleman accompanying here on the stage. Powering that, we've also kind of gone from zero to a much larger number. There's been some very infamous cases where things have worked less well. Many of those probably know about the infamous hacks at the likes of Mt. Gox or Bitfinex or the many others, or possibly some of the tools out there that we're trying to decentralize that and use other techniques. The actual assets themselves have also undergone a very radical transformation from the Wild West days that aren't that far behind us of unregulated ICOs into more established, rule-abiding securities tokens offerings, utilities tokens offerings, or many other different forms that we're seeing in this. It's a rapidly changing world. I'd like to better understand what exactly is happening from not only the new entrants to the market, but companies that have been around since before the launch of Bitcoin. So to talk to us about that, we have two people representing either side of that, and I'm very lucky to have that because I think that it gives us good balance and it gives us a good way to look at how these things will come up, how to deliver them, maybe what order we might see them happen. So without further ado, I might introduce my panelists here. Artem Duvanov from the National Securities Settlement Depository in Russia, Joseph Lubin, the CEO of Consensus, Walter Verbeek from the Euroclear Group, and Igor Ockman from BankX. Thank you very much for joining me today. So I'll have you guys introduce yourselves, but as you do, can I also get your take on what is a crypto asset? How would you define it?
Okay, let's start from me. So my name is Artem Duvanov. I'm head of innovation at National Settlement Depository. It's Central Securities Depository of Russia. So answering your question about crypto assets. So in my view, the term is quite ambiguous, yes, because there is narrow meaning and wide meaning. In narrow meaning, we used to call crypto assets that just cryptocurrencies and utility tokens, which exist only in blockchain and used as a mostly means of payment and doesn't give any rights. And that's financial definition, I would say, of crypto assets. And in our, it's more technical. That's actually any assets which are represented by tokens. And that can be cryptocurrency again, or security, or fiat currency, doesn't matter. What is matter is how we transfer rights. So that's two meanings.
Thank you.
Cool. My name is Joseph Lubin, background in tech and finance. Was one of the founders of the Ethereum platform and started a company called Consensus about 4 years ago to essentially continue the vision of the Ethereum platform. Currently, we operate along 4 prongs of activity. We build product, including lots of infrastructure for the Ethereum ecosystem. We do consulting work, we do education, we do various capital markets activities. Those capital markets activities involve things that we call tokens, tokenized securities, consumer utility tokens. The technical definition is that we essentially use something called public key cryptography, which involves having a private number and a public number that's derived from the private number. The private number gives us control. The public number can serve as identity or an address that can essentially be the owner of an asset. Assets themselves could be realized as those pairs of private and public numbers or as just entries in a ledger in a smart contract on a blockchain platform. The blockchain is a breakthrough database technology that enables us to automate trust and guarantee execution. If you have an infrastructure like that, you can create something that we like to call digitally scarce assets. So we can create money or securities or various other kinds of representations of assets in the world or natively digital assets, and we can all trust that those are not improperly manipulable. They're not subject to double spending or counterfeiting.
So my name is Walter Verbeek. I'm responsible for innovation and the business model for the Euroclear Group. The Euroclear Group is 7 market infrastructures, 7 CSDs, covering France, Belgium, the Netherlands, Sweden, Norway, the UK and Ireland, and then also an international infrastructure called Euroclear Bank, which is an ICSD. We tend to look more and more at what we do today as just one use case, which is the CSD use case. But there are so many more use cases that you can come up with in a market infrastructure, both in terms of roles you want to play, which may fall within the scope of a CSD or beyond, but could also, in terms of technology, expand from the current situation where things tend to be more centralized, where you say now technology offers us the opportunity to see where we can address certain business problems in a wider variety of technology options. And some of it will imply DLT technology. Others, you may say, no, we just need the crypto, but we're going to do it centralized. And others you will keep central. As to your question, everybody's... there's a race going on now on defining the classification for the different groups. We, as a group of CSDs, together with many other CSDs, and by the way, 28 at this stage, we've been working ourselves on what could be a classification, and we published a paper under the auspices of ISA, coming up with 4 groups. And that's just us being in the post-trade. We consider ourselves to be the plumbers of the industry. So we say, how do you bucket it so that we can process it in a way that we think we in the ecosystem can work? And so one is obviously the crypto currencies, pure sang. Then there's the utility tokens. Then we see on the other extreme the asset-backed tokens, where we say from our perspective it's a token, and there's in the real world there's an asset behind that can be a house, real estate, can be fine art, whatever, can be a commodity. And then in between there's this cute new class, which is the STOs, so the securities tokens, i.e. it's a new class. It's not an equity, it's not fixed income, not an ETF, not a fund, it's an STO. And if you look at the US with the Howley rule, certain of those things are really considered securities. So it's a separate asset class. So that's what we're going for the time being, wherein each of our institutions is in active dialogue with the regulators. On our side, it would be more the ECB, the Eurosystem, the regulator, the European regulator, ESMA, and of course, many of our national regulators. And I see us landing. I know already some of them will deliver on a first definition set by the end of the year, and I think we will come to a stable environment before the summer of next year.
Thank you. My name is Edgar Ockman. I'm the founder and CEO of BankX. BankX, we're building infrastructure for making securitization on blockchain. It includes crypto custody solutions, security token exchanges, and a lot of infrastructure to track the asset value before it was tokenized, before it was securitized. My background is I used to work for McKinsey, Citadel hedge fund in Chicago. I was head of innovation lab in Sberbank in Russia and graduated from Stanford Business School. So then founded BankX. It's 150 people right now, so mostly clients in the United States and Asia. So our case is what we do. We are serving some financial institutions with providing them settlement agent services and some particular niche services that they need for securitization. And we are thinking about crypto asset as about two things. So on the first layer, it's all about RegTech. It's about how to simplify the issuance of tokens that is backed by equity or by a particular security and make it automated, make it quick, make the settlement quick, reliable, and to make possible all the regulation that already exists to work like machine. So to automate the lawyer's work. So this is the first level complexity and like iceberg. The top, and but the second level, which is even more interesting, it's when we bring in the blockchain to the life of the asset, and we can trace the cash flows that exist in the industry, and this is we name this proof of asset protocol. So this is how we can prove the real value behind the security or behind the token. So this exactly brings us to the problem of subprime mortgage crisis. So when basically we as a financial community lost the understanding of what's behind the security. So here, because of the blockchain, we can get instance audit and we can understand. So this is, I think, this is the most perspective on the future of crypto assets.
And I think you brought up some very good points around some of the advantages, and I'd like to turn it to you, Joe. When you look at crypto assets at the wide angle, what are some of the things you go, this is new, this could never happen without having a crypto asset?
Traditionally, I could put money into a company, an investment, and I could rely on the people in the company to work hard, and I would rely on them for return on my investment. We have a new sort of construct that we sometimes call a protocol-based open platform or a network business model where we can stand up a community, define a set of rules, embody some of those rules in a token, a consumer utility token, and incentivize different actors, people, and companies to inhabit different roles on this platform and ideally service one another and service consumers of that platform. So we've done a handful of these in the music space. We've got a supply chain system that's moving towards that same sort of network platform. So these are new ways that we can organize for collective action. A little while ago, Bill Hinman, Director of Corporate Finance at the SEC, said some positive things about how decentralized the Ether cryptocurrency is, and that they didn't consider it security. But much more importantly, they've been doing a lot of work to understand what's going on in our ecosystem, and initially they said everything that they saw was a security, but much more recently they've agreed that if you structure one of these tokens properly as a consumer utility token, and if you market it correctly so that you're not marketing it as a speculative investment to investor types, then they would be comfortable that that sort of token is not, in fact, a security.
And I think there's some very important things you pulled out through. There's many different forms, and certainly some people are seeking to make securities that we're familiar with in more traditional markets, and there's people that are designing something new and needs to be reconsidered. From a regulatory point of view, you hit on some of the US topics. In Europe, what is happening? What are you seeing at Euroclear? And are we seeing a move to potentially consider tokens that might not be securities dealt with by more traditional institutions?
It's too early to say, and I think it's going to be both. I think you will have certain tokens that will stand the test of a security, and hence they will. The question will even be CSDs, according to the current regulation, you need to handle those if they are traded also under another regulation, which is called MiFID II, so not necessarily, but some of them, you will even be forced as a CSD to say, I need to be able to manage that. But there's going to be another class that may not pass the test of a security, but nevertheless does the same function. And to give you one example, so where regulation is, we are one of the investors into I would call it a test bed, but it's called LiquidShares in the French market. And the problem statement there was, okay, each of us as a CSD, we hold typically the most liquid assets. If you look at equities, so let's say 1,000, 2,000, then you say, and how many companies are in that country? Probably 200,000 or 300,000. So how about the 99.9% others? And how can you help the liquidity and the transparency in that environment? So I'm talking about the small and medium-sized enterprises. So LiquidShares is really about how can we bring oil in the real economy, and oil, i.e. funding and making the SMEs less dependent of going through banks who need to fund them, but then, of course, because of Basel III, it's becoming very costly. So how can you allow a bank to be the agent, but without tapping into the balance sheet? And, of course, the real economy being the SMEs, and trying to find a way that is palatable to them. And if you look at the initial ICOs of smaller companies, the issuance cost is much lower. They were at 150, whereas if you want to issue a bond or do an IPO, okay, you talk about a multiple. So suddenly you reduce the hurdle for a lot of companies to get access to a capital market, whereas today it would be on the one hand crowdfunding, or on the other hand going to your house bank and asking for a loan. So, but the point is, and we're looking at that together with the French authorities, the IMF, which is actually very, I would say, avant-gardistic in the sense that the French state has already defined a certain law, and now it's up to the regulator to define more the second level and third level regulation to say, how can we make this work? So it's kind of collaborating with the regulators to say, that can work, that doesn't work. Does it need to be a security? Can it be something else as well?
Yeah, so one interesting aspect of the LiquidShares project is that we could design a fully decentralized architecture, and we did design a fully decentralized architecture, but because of how the regulations are written, you need a centralized depository in place, and so you have to sort of add a little piece to the architecture in order to satisfy the law. Ideally, over time, as you demonstrate that this sort of system can work properly without this appendage to it, then maybe we can have discussions about revising the laws.
Appendages are to...
First time I hear CSDs described as an appendix, but it's one to remember.
Certainly there's new challenges, and the business, in addition to acting as that centerpiece, which is indeed ensconced in the law in many jurisdictions, there is a security aspect, and one could envisage even a fully decentralized world. Many companies would like the security of relying on custodial solutions to hold on to these, whatever they are, assets. How are traditional CSDs reacting to this?
Yeah, you didn't say, you asked me.
I asked at the beginning.
You just look at me. Yeah, so well, one of two incumbents at this stage. Yeah, actually, yeah. So they're reacting in very different ways. Yeah. So, as we know, statistics says that disruptive innovations are survived by just 5% of incumbents. I hope we too belongs to this 5%. So our reaction is we actually are trying to be one of leaders, yes, of this change and create solutions. Yeah, for example, in our case, we are a leading initiative to create what we call decentralized distributed depository. It's called D3 Ledger. It's mimic post-trade infrastructure and do the same functions, what we call post-trade, safekeeping, settlements, asset servicing, but it's done in decentralized way. Yeah, yeah, so and lots of benefits which are coming from that. The same is done by some other organizations, but there are lots of actually who are waiting for several reasons. One reason is they are waiting for the regulators to come up and say, let's do that. Yeah. Yes, or you are allowed to do that. That's the first reason. And second reason is that actually that's balance of power. between infrastructure organization and its clients. Yeah, so who are actually considered as innovators at the market. Yeah, so in some markets, infrastructure organization that just pure back office, and should be be the most conservative organization at the market. Yeah, so.
Igor, you guys are building the disruptive stuff, right? You won't need them in 5 years, right? So it's good that they're moving, but what do you think is changing? And do you think that this 5% survivorship ratio is correct from the incumbents? Do you think it's something that the tools are out there now, we can just move it all to that? Or is it something to say it's a partnership? What is it?
Yeah, I come from background. My background is corporate ventures, and I was in the business of acquiring companies, integrating with the banks, rolling out. I saw that it takes about 1 year, basically, to integrate a good technology company and to run on the banks because of the many reasons, because of their regulatory, because of their monolith IT structure. So it's not microservice, not agile. So this is the value that blockchain brings here. So I see that of course everybody will stay. No, the banks will benefit from the technology, and there should be the synergy. So right now, for instance, the crypto market and the exchanges, they're missing institutional money, and everybody there is chasing institutional money. They're coming, and when I'm talking to institutions, they say, yeah, but we don't want to be hacked on these exchanges. We don't trust. We don't need this agency risk, and they're missing depositarium there, the real stuff, and but depositariums do not work with the exchanges. So they are looking for solutions, maybe decentralized exchanges where they keep all the crypto on their side and their perimeter, but the decentralized exchange is missing the liquidity and the speed. So there is many problems there, and I think the right solution is when the depositariums, the traditional depositariums, will start to work with crypto exchanges. So our approach for that, we are bringing depositarium as a service. So this concept bank as a service, so bringing depositarium as a service. We don't have license ourselves, but we deploying this in Amazon Cloud, and we're gonna release like Amazon Web Services. So then you as a bank, you can or depositarium, you can download this application like you do with your phone, and release this in a matter of few weeks. So this is I believe this is where the integration between traditional financial industry and newcomers, new incumbents should go through this cloud integration and through this as a service relationship.
Yeah, jump in a little. So a CSD is a conceptual construct, and it has a physical manifestation just because that's what we knew how to build. But it can continue to exist as a conceptual or logical construct, but it can take on a decentralized implementation. So a group of financial institutions can get together and they can define a protocol and they can build that system. And there doesn't need to be a central physical clearinghouse or implementation, central database. It can be realized as a set of nodes on a decentralized network. So the gatekeepers, the financial institutions and the regulators can serve that gatekeeper role. You need that sort of thing in order to conform to the laws, in order to have a well-functioning system in legal society. But the architecture can change. It can get much more robust.
And on that point, one thing that I often hear from incumbents is, well, we have the client base. But what I heard you saying in your introductory was we're talking about a much wider client base and possibly very different clients as well. Do you think that that's something in these new protocols, these new ways of working that will become more widely used, or do you think we'll see a reversion to what we talk a lot about, institutions?
Sure, enormously more widely used. So whether it's tokenized securities, it's going to be natural logical progression to issue equities or bonds or other kinds of instruments in these natively digital forms. They clear and settle in the instant of the transaction. You can track them in real time. You always know where things are. You don't need to reconcile these different instruments across different databases. There's a single shared ledger. You know where everything is, all the flows, all the static value. And you have these other kinds of instruments, these consumer utility tokens, so you can spin up different kinds of platforms that don't need to pay attention to securities laws because they lie outside that jurisdiction. We're also, and this is maybe a bigger concept, we're also seeing the IT industry de-silo itself as we have these protocols for trusted transactions, automated agreements, smart software objects, decentralized storage, decentralized bandwidth. All of these decentralized protocols have their own crypto commodity token associated with them. And so instead of having IT corporations with their business development, sales force, and sort of heavy infrastructure for selling storage and compute and bandwidth into companies and to consumers. All of this is going to become very granularly commoditized. So all of these tokens will be tradable in radically free open markets, and they will it'll start to look like the energy markets or the metals markets or the grains markets, where you have these many different providers, many different consumers, financial infrastructure that pops up to enable the suppliers to hedge out their price risks over time, enable the consumers to provision for their needs over time. So we'll have futures and options and other sorts of financial instruments. It's going to be very pervasive.
New clients, pervasive new assets. Is Euroclear or NSD ready for that?
Yeah, we're ready for a brave new world.
That's good to hear.
Now, it's interesting to say, because if you look at the CSD, you could say it's technology, but I don't think that the people in the room look at the CSD with that perspective, and you already alluded to it. What we bring to the market is just two things: safety and efficiency. Yeah. And that's what the market looks for, because then you have the traditional investors, asset managers, pension funds, in which you and I invest, that say, okay, now I feel comfortable to go there. And it's remarkable, because we did the exercise with the entire group. So NSD, DTCC, there are several of the colleagues who are sitting in the room. And we looked at what is now the difference between the world we know, which is because of the limitations of the technology, a centralized world, and what we do if you now move it into a DLT environment, that same asset, security, and what if you do crypto in that same DLT environment. And what we saw was that actually the challenges or the needs you have from moving from central to DLT and from moving to DLT to crypto on DLT, that actually the service needs, that's 80%. Mm-hmm. That's 20%. And the reason is simple. When people, you know, as a CSD, we're not a service company in the sense that we provide products and services. We were created by the market to say a capital market has a number of inherent risks. Counterparty risk, liquidity risk. If you need to do pre-funding, good luck, because then you need to have a stack of assets and a stack of cash. If you want to trade with anyone without a central counterparty, good luck. You need to know 5 billion people and do a credit assessment on that. So there's credit risk, settlement risk, legal risk, judicial risk. There's so many risks, but they're not inherent to securities as compared to another asset class. They're not inherent to a market infrastructure, be it a trading venue, a clearing venue, or a settlement venue like CSDs. They're inherent to the capital market. It's because you enter the capital market that some of those risks exist. And those capital markets, they have created CSDs to say, mitigate some of those risks. And so when you say okay, now we're going to move to DLT, things that the capital markets have organized in a centralized way, suddenly you say, no, no, it's going to be distributed. But there's a, so the point is, in that distributed world, you need to arrange around roles and controls and governance systems by which you can ensure that same type of safe and efficient environment so that people move there. And then the next step would be, yeah, and now if you move to a new asset class, being crypto, how do you deal with that in order to, again, offer that safe and efficient environment? Now, but that was an eye-opener for the entire group to say, we would have expected initially, or going in position was, crypto, that's going to require 80% of additional services and things we need to be concerned about. And the DLT stuff that's the easy part. It's actually just the other way around. 80% of the complexity or the new things to think about, it's about moving from central to a DLT environment. And the interesting thing is that some of those roles and pieces of infrastructure will fall more into our natural remit as a CSD, and we already made up our mind that other stuff, they're out of our league, and so it should be others doing that. Now, then the question is, what is more into our natural remit? It would be anything around safekeeping, the notary role. You want someone to say, yes, this is yours, or at least to sanction that. And the jury is out around DVP settlement, because what you want also is something around when the asset leaves your portfolio, that the cash gets into your account or wherever it is. And we're used in our industry to say the only way we know how to do that is DVP settlement, delivery versus payment. No cash. If your counterparty doesn't have the cash, well, then don't move the asset, and vice versa. I understand that some people within the industry say, well, you know, if you go through DLT and crypto, you may not need DVP settlement. I would dare to question that, but it's a working hypothesis. The last one is on liquidity management. I think there's a key concern in the current use cases around DLT, which is you move assets, whatever it is, or a claim, a token, and then you ask, and where is the cash lake of things? And people happily say that's outside the system. And they say, yeah, but aren't you then kind of introducing a risk? If I'm just want to invest in that, do I feel comfortable enough? So that's one thing. The other one is, if you move it around, some people will want to cash in. If you're trading on a certain token, and at the end of the day, as a trader, you made good business, you will say, I want to see the proceeds of that in real cash, because it has to go into my P&L. So how do you deal with that? That you translate what has happened and you've created value in that virtual world. How does it still find its way in cash, and how does it find its representation in the accounts?
Let me elaborate a little bit on that, yeah, because I would oppose the view that actually we are moving from centralized world to decentralized world. Yeah, I don't think it's correct. And this is misunderstanding which stems from initial kind of view on the role that Bitcoin or Ethereum or other public cryptocurrencies and blockchain will play. So I think at this moment we all understand that blockchain, that's innovation, but that's technological innovation. Yeah. So and that has to be followed by financial innovations, by new asset classes, by new business models. That will happen. But that doesn't mean that in this new brave world we will not see like companies providing services. Yeah, so again, they will be companies which provide services using DLT for crypto assets, but anyway, and this world, again, it will be centralized in a sense that there is a service company and there is client. So that's, I think, very important thing to mention. Another, I just would like to support what you said about cash lag. Yeah, because we all here are focusing on security side, but security markets, they don't exist without actually means of payment. Whatever it is cryptocurrency or it is a fiat currency, and tokenized form or stable coin, whatever, yeah, but that has to be inside of this DLT environment in order actually we can create this settlement infrastructure and support purely decentralized in technical sense financial markets.
Yeah, so what we've seen early on is some tentative experiments by different financial institutions that are trying to sort of test the technology to shadow things that are happening in the real world in the technology. The technology itself is immature, so that cash leg, you could do it in Bitcoin, you could do it in Ether, but these are volatile instruments right now, just because the systems are very young and growing quickly. There are, on the Ethereum platform, 10 or more what we call price-stable tokens. These are tokens that are either one-to-one asset-backed with money in the bank, or they are over-collateralized instruments, and there are hundreds of millions of dollars now in these kinds of price-stable tokens. Most track the US dollar. And so as institutions get more comfortable using those sorts of instruments, the cash leg happens on the blockchain, and DVP is an atomic swap in a smart contract.
Igor, can I pull you in on this? What is your reaction on the points made about liquidity and new risks? How are those being managed?
So the liquidity is created as when there is similar assets, when there is fungibility between assets, and one of the bigger benefits of blockchain that is create a kind of strict API and strict way to write legal contracts and make something that is not really was comparable and fungible, looks similar. So we're working right now on the one. Our approach is like building asset classes, new asset classes, and the first one is like what we do is movie coin. It's when we do financing of the movies. Each of them is like average budget $35 million. Half of that provided by banks, half of that is equity financing, and traditionally it was even term in Hollywood named Hollywood accounting, because each of these contracts, they're kind of something very unique with a lot of hidden like small letters there. So with blockchain, we're pushing the standardized standard there to Hollywood, and we are pushing some standardized way to finance movies, and that's why the movies looks comparable and become basically asset class and be their security tokens backed by this portfolio of movies that is, and we're bringing them to the capital markets and to the security token exchanges, and so they hopefully will become tradable, and we already get interaction through. We are underwriting the whole the first slate of movies. We're raising $250 million, and we have a lot of interest from the invest community. So this is where the world is going, I believe. So we're gonna do this with movies. We're gonna do this then already discussing music. Royalty rights, some art collection, or even horses. So many assets that used to be like very kind of very one thing that not really comparable, that becomes standardized in the way, and we're gonna bring all the security tokens to CSDs and deposit there. So this is where we connected.
Yeah, so with respect to liquidity, I think we're going to move into a qualitatively different regime. We've had all these different kinds of financial instruments, and they need to trade on their own specialized markets. You need regulation, compliance that are specific for different kinds of instruments. We are starting to realize all of these instruments in essentially the same form, whether it's a cryptocurrency or a debt instrument or an equity or a Beyonce ticket. It's all just one of these cryptographic tokens, and so we can build compliance into these smart contracts, these programs on the blockchain, such that you don't need a headcount of hundreds or thousands of compliance officers in financial institutions, and you can specify how different instruments should trade so that there may be no reason why I can't buy Apple stock with my Beyonce ticket at some point in the future.
Or CryptoKitties, one of my favorite assets.
Absolutely.
As an incumbent, I should mention, I believe compliance will stay. Yeah, so.
I would expect that compliance stays as well.
It just gets much more efficient, I think.
Of course. Yeah.
And also, it becomes built into the instrument. It becomes impossible to fat finger a trade. It doesn't become so post facto remediation.
I would put it in a way that actually blockchain provides more transparency, yes, and more standardization, and that's why actually we expect that compliance risk and compliance cost will just go down because of using blockchain. Yes.
There's an interesting thing that comes into there is figuring out, where these limits should be. And these gentlemen working for incumbents have done that for a few years. And we know what we would give a haircut to a certain asset class if we were going to use it as collateral. Do you think that that's something that would come into these markets from incumbents that have done it? Or do you think it's something that we'll figure out on a markets basis, maybe with these new technologies? Or is there a third way, possibly?
Well, what I see is it has to be driven by a problem statement, and it has to be driven by economics. It has to make sense. Or you materially reduce cost, and so therefore the benefit to the client is there because you can offer the same thing at a lower price, or it's because you can offer more, and there's new stuff. What I see, I think it's less crypto, I think it's digitalization, because conceptually, if you think through a smart contract, then everything becomes blurred. Because a smart contract, if you know, in our world, you say an equity, fixed income, ETF, or an STO, or an asset-backed, or, there's another interesting thing is, imagine you have a kid, and that is quite prodigious, following a sporting career. What parents of those kids have been doing generations is trying to find money, because it costs tons of money to do that. Imagine you could do that through tokens. Because then it's kind of an investment. You want this child who is 10 years old and is playing wonderfully a sport, say, well, I'm going to invest in that kid. And if that kid does Roland Garros, okay, each time Roland Garros is there, I will cash in $2,500. Great. And if not, well, I've at least tried to help someone in my society to move forward. Exactly. That is great. So where I think a lot in our world, where I see the biggest opportunity, there's always this fight. If you look at complexity in our world, it's typically because people are sitting on a database, but that database is actually a client franchise. And I'm not willing to share my client franchise with you, because the day after, you're going to go after my clients. And the result is that we wind up in a spaghetti network and we need to reconcile. What blockchain and crypto allows is to create a common ledger, and nevertheless, if you have several stakeholders in a market to make the market function, that each continues to sit on its own client franchise. Best example on point, funds. If you look at TAs, there's hundreds and hundreds of TAs, and then you have the distributors. And it's trying to combine everything. Imagine you could say you create a common ledger, and each TA as a node sits on its client franchise of issuers. You still create that efficiency, and you don't open up the book so that TAs goes after each other. The other one would be e-voting. We think in DLT blockchain as, oh yeah, obviously that's the chain between the end investor, you and me, and then the ultimate issuer. You could also say, no, actually, it could be a good use case because it allows the issuing paying agent to protect its own franchise, and the custodian, the global custodian, or whoever acts on behalf of the end investor, to sit on its franchise, and nevertheless, because there's this common ledger, to create that efficiency. Now, if we could pull off a number of those use cases, I think we would create a lot of value to to the people who invest in traditional asset classes. And it will help the crypto asset class to be much more rapidly also considered as a traditional thing in which you can invest.
I completely agree with Walter. We usually innovations coming from cost-cutting side, so it's much easier to explain to financial institutions that how they can save the money. And but the next one, it's the major thing. It's cost-cutting and automation. Many RegTech regulation things that it's enabler, so it decrease the barrier of new things, so you can make like something that used to be like very complex, like for instance in the US, like make another one Reg A plus issuance security. When it becomes like automated and you can do this automatically cheaply, like in a week, then you understand that you can bring like the whole market of the securities. You can trade them. There is liquidity there. There is new money there. So it's a very cool thing. I remember when I was head of innovation, like in the big bank. So we had like 80 million clients. We had like 300,000 employees. And once the CEO of the bank decided to collect all the information that just the banks know about one client. And they found out that is basically he sent an order like to collect this information, and the people never come back to him. So once they found out that there are like 70 different databases and 70 different owners within the bank, and they even within one bank they didn't want to share this with each other because they were afraid, of different internal compliance and of the issues that somebody will steal this client even within the bank. So it's only after direct order of the CEO of the bank to collect this information that they were pulling this, and took like 2 weeks to collect all this data. so it's even just within one bank to integrate the blockchain, it would be like a big beneficial because the people start to trust each other within.
Yeah, sure. There's an interesting thing that I'm hearing about, even looking at opening and sharing these client networks or client databases. You have some of the companies are looking at this and saying, we don't even ever consider the idea that a client would be owned by anybody. It's an open network. Do you think that that's something that's going to radically change business models? Am I looking at this in a too utopia of a vision? Joe?
Sure, I'll take that. At the end of the day, I think we're going to continue to need financial services all over the place, probably much, much more. And I think this technology just lowers the barrier to entry. In highly regulated places, there will still be fairly high barriers to entry. I think they'll lower somewhat, and more agile, smaller financial institutions will pop up and provide investment services and insurance and other sorts of financial products. It's going to be very interesting what happens in less regulated jurisdictions that are, you have small startups that are essentially fulfilling the needs of the people in those jurisdictions, and the context of blockchain is global. If you're creating pools of capital that you're lending against or insuring against, you might end up competing with slower moving, larger financial institutions in different jurisdictions. So it's going to be very interesting how those two dynamics, or those two forces interact with one another.
Yeah, I think concept of owning a customer, yeah, it will be with us forever. Yeah, I hope so. But blockchain actually enables at least one business model, which I think is still new for financial industry. That's platform business model. So probably we will see more kind of adoption of this business model in financial industry, just due to like Facebook, financial Facebook or whatever. Yeah, it may come. Yeah, because of blockchain.
Hopefully they have better data security.
Yeah, so currently it is about owning the customer in a significant way. Yeah. I think it's going to evolve to the customer sort of owning itself, owning its identity, owning its data, self-sovereign identity, and it's going to be about having much more fluid financial relationships so that I can interact, I can move my bank account if I have one from this institution to this institution much more quickly, or just have logically centralized KYC mechanisms so that it's much more fluid, and I have much greater agency over my financial life.
So imagine the headache. We're having headaches over this on how it will pan out. Imagine the headaches for government, both from, just incomes, so taxation. Imagine you run 10 nodes, and those nodes are run 2 in country A, 3 in country B, 4 in country 4, etc. And actually the operator is then in country 6, the governance is in country 7. What law does apply? And if you're a regulator, how do you organize yourself? Because if it's kind of material to your society, because I'm no longer talking about economy, this is going one level deeper, you want to have some say over that, because if you're unable to do that, your government will say, hey, this is happening under your watch. What are you doing to safeguard the interest of my country and your countrymen? And so trying to handle through that, also on the cyber, you could say, okay, it's still well boxed in, but it's global. So how can you make sure that, if there's a cyber attack, not happening within your country, but outside, but it's in the chain, and ultimately it tickles through. So this will also, from a authority and regulator point of view, bring a new. They will be forced to go also into a much more collaborative mode,
sure.
Which is interesting.
This is a complex set of discussions that our society is going to have for years. But we already have architectures that can offer solutions. So in the public Ethereum network, we have the base layer, the trust layer, but we have layer 2 where we have different technologies that are providing scalability solutions, privacy solutions, and potentially regional solutions, so that we could, Switzerland could have its own Ethereum-based network for certain kinds of transactions, and through a technology called Plasma, you can issue instruments, issue tokens on that network or on the main network and have them move back and forth. That particular network in the public Ethereum context can go sideways. Something bad can happen to it, and still everybody who has assets on that network can pull those assets back to the safety of the radically decentralized base layer. So we can take that sort of architecture and replicate it in a purely private system too, where there's a system, a base layer that's international, and a layer 2 that handles regional issues.
So Igor, all this sounds cool. I'm sure it's all 20 years down the road, right? None of it's ready? What do you guys think?
No. It's we just Joe said about Plasma. We do the Plasma. It's right now the speed is like regular Ethereum. It's about 20 transactions per second. On Plasma, we can do like 22,000 transactions per second. So SLA is still not there yet, frankly speaking. but probably by March we're gonna release like and some other teams on the market like Plasma Enterprise. So it's basically where you can deploy this for your whatever Microsoft Azure or something like, or the solution that you're already using, and so it's coming. So it's we're going and through integrations through existing providers like Oracle, IBM, Microsoft, Amazon, and so you get access to this. To blockchain, and you don't have to deploy a completely new infrastructure, so just using existing one. And the custodian solutions, it's also already there, so you can there is a number of like traditional custodians, crypto custodians. There is like guys like us who do this in cloud. And the cloud is much better because of the segregated accounts are supported. You can do private cloud custodian. You can basically open custodian on your servers. So many industry maturing, like basically every 6 months, it's just next stage. So I expect that is by March you already see the new market that is already here, like in several industries, like based on blockchain.
Archer and Walter, you guys both look very comfortable with that timeline.
Entirely under control.
Do you think that the industry is looking at it with a similar time frame? Do you think that it's a fair timeline to move forward?
in terms of timelines and forecasting, yes, it's always difficult.
Crystal ball.
Yeah, because we always, people tend to actually overestimate short-term benefits and underestimate long-term. Mm-hmm. Now I think there were expectations that we will have kind of a more, 3 years ago, I think many people expected that we will have more today, that they will be already some adoption. We actually still don't see large adoption of blockchain. But what I believe that now we're in a position of underestimating long term. And in 2-3 years, what I believe, we will see that many of these 95% of incumbents will wake up, because there will be strong adoption, at least in some segments of financial markets, and there will be huge competition. But long term, when financial industry, infrastructure, and markets will transform based on blockchain, I think it will take lots of time, like adoption for internet, so it may be 20 years, and the same will be for blockchain. So it's a long story ahead.
Well, so from our perspective, we're seeing extremely rapid adoption. So adoption often follows an S-curve. At the top of that S-curve, you may have the masses, the end user consumer who find real utility in different applications. At this part of the curve, we are creating killer applications for the builders who are creating more fundamental infrastructure for the ecosystem. So from different tokens like fungible tokens, non-fungible tokens, security tokens, identity systems, reputation systems, legally enforceable agreements, atomic swap protocols, decentralized exchanges, naming services, data feeds, price stable tokens. All these different pieces are getting put together into increasingly interesting applications. We've got games coming out. That's going to be a good, safe place to try out these scalability solutions, to enable these digitally scarce assets to move from one game to another game, or from one game to an exchange. And so in the journalism industry, we'll probably see a breakthrough this year. In gaming, definitely. But it's all in these early stages, as it was with the internet. It's all about building the standards, the building blocks, so that we can all deliver value to the masses.
I guess there's the Sibos of the Ethereum world coming up very soon. We'll probably, you got a lot of things up your sleeve there, I imagine.
It's called DevCon, exactly.
Yeah. 6 months from now.
Absolutely.
But I concur with Joe. I think what we've seen, it's innovation. It starts very slow, and then people say, it's going to take a long time. But each time innovation, at a certain moment, there's a pickup point, and then there's this exponential curve. And we've seen that in our industry as well. 50 years ago, when we started issuing Eurobonds, it actually, I was not there, but I hear the early people at Euroclear telling me, when it was still run by JP Morgan, that every 6 months, that platform would come to the investment committee of JP Morgan to say, we're still losing money. Do we pull the plug? So imagine, every 6 months, your 6 months is correct, but every 6 months they were saying, let's pull the plug. This is making a loss. It will never fly. Yeah. It took 12 years. So after 12 years of gradual growth, then suddenly you saw an exponential growth. I think because of the technology, not necessarily the crypto, but the fact that technology allows everyone to participate. So by nature, it's open access, it's open participation. People who have a good idea have now a much easier way to bring that to the critical mass. And so I think it's going to be much faster than the 12 years. It's going to be just a year or two from now where you definitely will already see in our industry the first use cases where really you make money. And my biggest worry is, and that's always the situation in an existing industry that is confronted by fairly material innovation, it's that, it's the metaphor of the frog. If you throw a frog in hot water, it will jump out within the millisecond. if you put a frog in nice water and you heat it gradually, the frog will boil. And the point is, how can we create in our industry that level of awareness so that we shouldn't be panicking. That's not the point, but to say, hey, this might heat up fairly fast, and so we need to be ready for that. And I think it's about collaboration, and it's sharing best practices. Again, when you look at the group of CSDs, that's what we are going to do in the coming months, is really say, you guys are working on this, you're working on that. What are the lessons learned? So how can we learn from each other and make sure that we offer services to the capital market so that, again, you provide a safe and efficient environment?
Yeah, so it's definitely rapid exponential growth. It's open source technology. It's being built on the shoulders of the internet protocols and the web protocols. It is a new trust infrastructure. The new trust infrastructure enables collaboration. That trust infrastructure also enables synergies between different applications. You create a new insurance product, and 100 different applications can now use that new insurance product because it's in the same execution space. It has a philosophical drive so that people are getting excited about transformation of economic, social, and political systems around the world. And by the way, it's got its own built-in money system. You can essentially create your own tokens of value to fund your product, and that's very attractive to lots of people.
But we have indicators officially of adoption. Yeah, it's very easy. I can give an example. In the middle of 19th, yes, so when internet was kind of growing, yes, and if you sell at that moment services based on internet, you basically always sell internet access to your clients because they rarely have that, and your service back, yeah. So, and that is what is happening now, yeah. So if we do some service based on blockchain, we also need to sell blockchain itself. And if you want to offer some tokens or blockchain-based services to customers, I mean to individuals, yes, so they still, most of them, they don't have kind of wallets on their blockchains, yes, so, and that's so I have, for example, 2 daughters. They know about cryptocurrency, but they don't have wallets on their smartphones. I think for me, yeah, the indicator of adoption will be when they install actually these wallets,
or when you find out that they've installed those wallets.
Yeah. And the same is for companies. Yes. So when we are in a position that actually when we offer some blockchain-based services to our clients, and they just ask, oh, yeah, well, which kind of blockchain you use? Yeah, so, and that would be an indication of adoption is actually great.
And unfortunately, that's not the only indication we have that we are run out of time. But thank you very much. I've certainly learned a lot. And I think hopefully you guys will be around if people in the audience have questions afterwards. Thank you.
Thank you.